हेलो एवरीवन, आप सभी का फिर से एक बार स्वागत है मेरे YouTube चैनल में जिसका नाम है कॉमर्स ट्रेजर। इन दिस वीडियो वी आर गोइंग टू कंटिन्यू आवर डिस्कशन ऑन Q20 series for upcoming NET and KSET exam. I have already made 7 more parts of this series. If you have not seen those parts, I am putting the playlist into the description as well as in the I button. And in this part we are going to discuss 20 questions on income tax which many of you wanted me to make. So without wasting much time, let us go to the 20 important questions of income tax. A person include only individual and HUF, individual HUF firm company only, individuals HUF company firm AOP or BOI, local authority, every artificial judicial person. So as per the Income Tax Act of 1961, person has been defined under section 2 subsection 31 of the act, which says that person includes individual HUF, which stands for Hindu Undivided Family, company, firm, AOP stands for Association of Persons, BOI stands for Body of Individuals, local authority, and every artificial judicial person. So option number D is the correct answer for this question. Year in which income is taxable is known as dash, and the year in which income is earned is known as dash. Previous year, assessment year, previous year, assessment year, previous year, previous year. So right option is option number B, that is assessment year and previous year. So the year in which your income is taxable is called as assessment year, which is usually a period of 12 months which starts from 1st of April and end with 31st of March of the next year. It is also called as income tax year, and previous year is nothing but the year in which the income is earned. It is the year preceding the assessment year or year which is immediately back to the assessment year. Generally, previous year is also of 12 months period, but in some cases it can be less than 12 months also. Assessment year is defined under section 2 subsection 9 of Income Tax Act, and previous year is defined under section 3 of the Income Tax Act. In which of the following cases income of previous year is assessable in the previous year itself? So as I said, in some cases there will be exceptions where the previous year or the year in which income is earned in the same year income tax is also going to be charged, or it becomes the assessment year. So let us see in which case it is done. Assessment of person living India, a person in employment in India, a person who is into illegal business, a person who is running a charitable institution. So this is done whenever the assessee is leaving India, or assessment of person who are leaving India and going to some other country from India. The amount of rebate under section 87A in case of resident individual having a total net taxable income up to rupees 5 lakh for assessment year 2021 is 30,000, 12,500, 20,000, 15,000. So it is rupees 12,500. Total income is to be rounded off to the nearest multiple of dash, and tax is to be rounded off to the nearest multiple of dash. 10 rupee, 100, 10, 10, 10, rupee, rupee. So always remember the income tax income as well as the tax is charged by rounding it off nearest to the multiple of 10. It is as per section 288A and section 288B. 288A is for income and 288B is for tax. For example, if the income of a person is rupees 2,87,956.75, it has to be rounded off to the nearing value, that is 2,87,960 rupees. If it is less than 5, for example, if the income would have been 2,87,954.75, then the nearest value would be 2,87,950 rupees. So in this way, income has to be rounded off to the nearest multiple of 10. Income accrued outside India and received outside India is taxable in case of resident and ordinary resident, resident but not ordinary resident, non-resident only, resident and ordinary resident, resident but not ordinary resident, and non-resident. So right answer is option number A. So whenever the income is accrued and received outside India, it is taxable only in the hands of resident or ordinarily resident. resident or ordinary resident is a person who satisfy one basic condition and both the additional conditions. Non-ordinary resident is a person who satisfy only one basic condition but he does not satisfy any additional conditions, and non-resident is a person who does not satisfy any basic condition. Now let us see few more important points to understand to whom we have to charge income tax and whom we should not charge income tax. Whenever income is earned and received in India, then it is taxable in the hands of all. Whenever the income is earned in India but received outside India, then also it is taxable in the hands of all. Whenever the income is received in India but it is earned outside India, again taxable in the hands of all. So you can just remember, whenever the income is earned or received in India, definitely it is taxable in the hands of all the citizens. Whenever income is earned and received outside India but the business or profession is being controlled from India, then it is taxable in the hands of resident and non-ordinary resident, but it is not taxable in the hands of non-residents. And whenever the income is earned and received outside India, it is taxable only in the hands of residents, and remaining two it is not taxable. Which of the following income is exempted from tax? Sum received by member of HUF, dividend received from a foreign company, agriculture income from Bangladesh, salary income from a non-profitable organization. So option number A, that is sum received by a member of HUF, is exempted under the Income Tax Act. So under section 10 subsection 2 it is exempted. Dividend received from foreign company is taxable, but from Indian company it was exempted under section 10 subsection 34 up to 2020 31st March. Income from agriculture in India is exempted under section 10 subsection 1, but from agriculture income outside India it is totally taxable. Dividend received by a shareholder from Indian company is exempted. Interest or any other expenditure incurred for earning such dividend shall be allowed as deduction, not be allowed as deduction, be allowed as deduction subjected to certain conditions, be allowed only if AO is satisfied that it is only interest expenditure. So option number B, that is it is not allowed as deduction, because we are not spending anything whenever we are receiving income in the form of dividend from Indian companies. Up to 2020 31st March it was exempted, but now it is chargeable from 1st April 2020 as per the new Finance Act in the hands of investors or the shareholders. Gross total income is arrived after only adding income under 5 heads of income? No. Adding income under 5 heads of income excluding losses? No. Adding income under 5 heads of income after applying clubbing provisions and making adjustment of set off and carry forward of losses? Definitely correct. So gross total income is nothing but adding of income from salary, income from house property, income from business or profession, income from capital gain, and income from other sources. And then you have to add clubbing of income if there is any clubbing of income, and you have to adjust the set off and carry forward of losses if there are any carry forward of losses. Once you get gross total income, from that if you are deducting the deductions from 80C to 80U, then whatever you get is called as net total income or taxable income. The children education allowance exempted under Income Tax Act is rupees 300 per month for maximum 2 children. No. 300 per month for maximum 4 children? No. 100 per month for maximum 2 children? Yes. So education allowance is 100 per month for 2 children, that is 1200 per annum per child into 2, so maximum 2400 per annum. If you are claiming hostel allowance, then it is 300 per month for maximum 2 children. Which of the following income is not chargeable as income of business or profession? Profit and gains of business carried on by assessee during previous year. This is definitely charged under income from business and profession. Income derived by a trade, professional or similar association from specific service performed for its member. This is also chargeable. Income from activity of owning and maintaining horse races? No, this is not chargeable under income from business or profession. It is charged under income from other sources. Salary received by a partner of a firm for the firm in which he is a partner, definitely this is also charged under income from business or profession. For availing exemption under section 54, which amount is eligible for availing exemption? Purchase construction of residential house property up to due date of return of income only. Deposit in capital gain account scheme up to due date of return of income only. Purchase or construction of a residential house property up to due date of return of income and deposit in capital gain account scheme up to due date of return of income. So this is correct option. Section 54 deals with capital gain on sale of residential house, and option number C is the correct answer for this. Long-term capital losses can be set off from which of the following? Short-term capital gain only, long-term capital gain only, income from business or profession, income from salary. So long-term capital loss goes only with long-term capital gain. In the same way, short-term capital loss goes with short-term capital gain or long-term capital gain. Loss from owning or maintaining horse race goes only with income from maintaining or owning horse race. Loss from speculation goes only with profit from speculation. Exempted income loss cannot be set off against any other income. For example, agriculture loss cannot be set off against any other income. Casual incomes like lottery, puzzles, etc. cannot be set off against any other income, and business and profession loss cannot be set off against income from salary. So I have made a specific video on this topic which includes 15 MCQs questions which are very important from exam point of view. I am putting the link into the description as well as in I button. Do watch that video which is important from the upcoming exam point of view. Deduction under section 80C to 80U cannot exceed gross total income, income from business or profession, income from house property. So 80C to 80U deduction, it should not exceed the gross total income. Option number A. Amount of deduction in case of person with severe disability under section 80U will be rupees 50,000, 75,000, rupees 1 lakh, rupees 1,25,000. So whenever you are claiming under 80U, 80U is nothing but whenever the assessee himself is a disabled person, then he can claim rupees 75,000 in case of normal disability, and if he has severe disability then he can claim up to amount of rupees 1,25,000. So option number D is the correct answer for this question. So you have to remember some important deductions like 80C, in which you can claim maximum up to 1,50,000 rupees. Then 80D, which deals with mediclaim policy, you can claim up to rupees 25,000 for individual, and if you are claiming for your parents which are above 60 years of age, you can claim 50,000 rupees. If the assessee himself is more than 60 years, then maximum he can claim 50,000 for himself and 50,000 for his parent, that is rupees 1 lakh. Then 80E for education, 100% of the amount which you are paying as interest on loan of education. Then 80TTA, which is for interest on savings bank account up to rupees 10,000. In the same way, there are many other deductions which you have to remember. I have also made a specific video on deductions from 80C and up to 80U. So watch those videos also. You can go into my playlist and watch out those videos on income tax. Consider the following problem relating to let out house property. Municipal value is rupees 60,000, fair rent is rupees 68,000. So whenever we are computing gross annual value, whichever is higher in municipal value and fair value, we have to take that. So it is 68,000. Then standard rent under the Rent Control Act is rupees 62,000. So when we compare higher value of municipal value and fair value with standard rent, whichever is less, we have to take that. Therefore 62,000 will be taken. Then we have to compare standard rent with actual rent received, and whichever is higher has to be taken as gross annual value. So therefore gross annual value is going to be option number C, 65,000 rupees. A short-term capital asset means a capital asset held by assessee for not more than 12 months immediately preceding the month of its transfer, 24 months immediately preceding the date of its transfer, 36 months immediately preceding the date of its transfer, none of the above. So short-term capital asset is one which you are holding for less than 36 months or 3 years. But in some cases it is 12 months. For example, in case of listed securities, zero coupon bonds, units of mutual funds, units of UTI, it is 12 months instead of 36 months. Clubbing of income means additional income of two partners, inclusion of income of other partners in assessee income, total income of various head, collection of income. So clubbing is nothing but whenever you are adding income of another person to the assessee's income. It is usually done whenever the wife income is added to the husband's income or children's income is added to their parents' income, and it is done usually after adding of total income of the 5 heads while calculating of gross total income. Income from subletting is charged under the head income from other sources, income from house property, capital gain, income from business. So whenever you are subletting, it is always charged under income from other sources. Concealment of information or false claims to reduce tax liabilities are cases of tax evasion, tax avoidance, tax planning, tax management. So whenever you conceal the information or give false claims, then it is called as tax evasion, which is illegal from law point of view. Tax avoidance is nothing but whenever you find out loopholes in the law and you try to take advantage of those loopholes to reduce your tax liability, then it is called as tax avoidance. You are trying to avoid the tax. And tax planning is nothing but it is systematic way of reducing the tax liability utilizing the deductions, exemptions as per the laws and rules. Tax evasion, as I said, is totally illegal. Tax avoidance is immoral, and tax planning is actually the best way of reducing your tax liability. So this is all about today's video. If you like the video, please hit a like button, and if you haven't subscribed my channel yet, please subscribe my channel and also press the bell icon so that you can get a notification as soon as I upload a new video. Thank you for watching the video, and let us meet again in another video.